Social Security Benefits Explained with financial planner Kyle Stacey. Kyle, welcome and thank you for your time.
Yeah, thanks for the introduction, Catherine. And we'll be kind of firing away here looking at Social Security today. So there's a million and one ways to kind of look at this. So we'll sort of start slow and kind of work our way through kind of the history of Social Security, some strategies around Social Security, maybe do some case studies, look at how it's taxed, and overall just how it impacts your overall financial situation. Before we go into some of the numbers, though, I wanted to give you a little history lesson on actually how Social Security came about. It actually all started in kind of the early 30s with Franklin Roosevelt, and sort of coming out of the Great Depression in the 20s and 30s. There was no sort of social structure as far as security financially for Americans. And many people were out of jobs. They weren't bringing on income. People didn't have enough food to put on the plate for their families. And so there was no backdrop. And so Roosevelt actually presented this idea in 1934 for Social Security, where people would pay a little bit into the system, and then there'd be something on the back end of that where they can draw income from. It actually got put into law in 1935, and then payroll taxes started coming out in 1937. And originally, when they structured Social Security, you had the option of taking a lump sum, or you could actually take an income stream from it. And so the first person to actually take money was good old Ernest Ackerman. He took the money and ran. So he took a lump sum, put a couple bucks into it, and he only put 5 cents into it, took 17 cents out, and sort of hit the road. There was also the first gal that took an income stream from it. Her name was Ida May, and she only paid into the system for 3 years. She paid like $24 into the system and collected for a number of years, and actually took out just under $23,000. And that, if you equate it to a rate of return, was 92,000%. Right. So there's been some adjustments throughout the 85 years or so that we've had Social Security. And it's going to continue to change as this thing evolves. But just a little bit of a history lesson there. And so when you're looking at Social Security, again, it's just important to look at kind of all facets of your life. You can kind of look at it in sort of like a three-legged stool, in a sense, is that Social Security is going to be kind of the number one priority there. Okay, when do you take it? Do you take it early, 62? Do you take it at full retirement age? You try and delay it. Some of you may be fortunate enough to have pension benefits from an employer or some sort of plan that you've paid into, whether it be a government, municipality, or corporation. These are very rare nowadays, but some of you may have those. And then obviously your personal savings, right? What have you saved over the course of your working career that you have to sort of draw on in addition to the Social Security benefits? And so that's kind of how you want to look at this. And then there's a ton of different things that actually go into what make up your benefit. So number one is going to be your age, right? How old are you? When are you eligible to take the benefits? How many years have you paid into it? It's not on this slide, but you've got to pay 40 quarters into the system, which is essentially 10 years of work history. So when you actually look at your pay stub, for those of you who are still working, and you look at the pay stub, there's something that says FICA on it, FICA. That's Social Security and Medicare. That's what you pay into the system and how much money is actually taken from your paycheck. And to be technical, it's 7.65% of your pay. That's what goes into the system for you to actually then eventually draw a benefit off of that. So obviously your age goes in there, how much money you've made and how much you've put into that. Also your future earnings. Are you expected to make a certain amount of money as you continue to work? That plays into your benefit. Some of you may have spouses that are earning more than another spouse, or there might be one primary breadwinner as a spousal earner, and then there's maybe one that doesn't have a spousal benefit. They are still entitled to benefits, which we'll talk about. If you're a widow or widower and you have a deceased spouse that you can collect income off of or a benefit, that's another one. Believe it or not, your marital status obviously is another big one. Not only current, but you may be able to claim off of a past spouse as well, whether that's a deceased spouse or an ex-spouse. We can talk about that a little bit. Disability, and then this is also another big one, pensions. If you have a pension that you did not pay into Social Security, this is pretty common amongst maybe city workers, municipalities, or government employees. They have separate pension systems, especially like school teachers, where they actually don't have FICA wages withdrawn from their paycheck. But if in a past life you did have a job where you paid into the system, you may be entitled to both benefits. But Social Security, they don't allow you to sort of double dip. They will actually reduce the Social Security if you have another pension. So this is considered windfall elimination provision. It's called WEP. Or government pension offset. Okay, so we won't spend a ton of time on that today, but just know that could also affect the benefits. This was really interesting as I was kind of combing through the slide deck. 9 out of 10 people 65 years and older are actually taking their benefit already. So some of them actually decided to take it early, and that's a pretty big number, especially when you look at these figures down here. 12% of men, 15% of women rely on Social Security for 90% of their income. That's a pretty non-insignificant amount of people. Okay, so 90% of those folks are relying on for income. So personal savings is obviously a big factor in that too, on how much you actually need to pull. But I thought that number was pretty staggering. All right, well, let's talk about a couple of changes that we've seen over the last couple of years, and we'll dive in on this. Kind of first and foremost, many of you that may be receiving Social Security or may have noticed on the statement that you receive or you gather every couple of years, there was a pretty big cost of living adjustment increase for people in 2023. It was almost 9%. And this was really to address the inflation that we've seen over the last several years. Social Security does have a cost of living to it. It's not guaranteed every single year. Some years it's lower, some years it's nothing. And then a year like last year, it was almost 9%. And so when you're figuring out your strategy, a lot of times, if you look at your full retirement age amount and you're trying to delay it, you typically get an 8% delayed credit if you delay it. But essentially, the Social Security Administration almost gave you one of those delayed years back with this big cost of living adjustment. Obviously, you're feeling the inflation, things like that, but just something to consider. And they also, because of inflation and these things are indexed for cost of living, they increase the amount of money in which people pay into the system. So in 2022, it was like $148,000 of your wages you paid into Social Security. But if you made, let's say, $180,000, you were fortunate enough to make more than that, you actually didn't pay into the system from any dollars over $148,000 and above. So sometimes people may notice that come like October, November, December, it's kind of considered like a holiday bonus. So you only pay into the system up to a certain amount of earned income. This year, it's $160,000. So it had a huge jump. It went from 148 to 160. So some of those that are fortunate enough to have salaries larger than that might not feel that extra bump in income until later in the year. And Social Security, the FICA wages that you pay into are comprised of two different pieces. And those two different pieces, that 7.65% that I mentioned you pay in FICA tax, is actually bifurcated into two pieces. 6.2% of that actually goes to Social Security, and there's 1.45% that goes into Medicare. Okay, so at a certain point, one falls off, and then there's certain thresholds in there, and then you get above, and then it comes back. But the Social Security falls off. That may change in the future. There's been a lot of talk that is just going to be infinite. Okay, so that would affect a lot of people. And then self-employed individuals, they still pay that, both sides of that. Okay. Social Security, the full retirement age amount, which is when you receive your unreduced benefit based on your work history and your age, is 67. In the past, it used to be 65. They then bumped it up to 66, and now it's 67. I would imagine in the next decade or so, that's probably going to change. But as it stands now, 67 is considered full retirement age. That's people born 1960 or later. Okay. The earnings limits I just mentioned, that's probably going to increase at some point in the future. I don't have a crystal ball on that, but just seems very likely that in order to keep the system funded and solvent, they're going to have to increase that limit. So it is expected. Okay. There are no shortage of rules when it comes to Social Security, right? Just as it would be. There's a couple of terms you want to understand before we kind of keep going a little further, but full retirement age is kind of the number one term as you look at Social Security, and that's where you always want to start. Your full retirement age is essentially the age at which a person becomes first eligible for an unreduced benefit. Okay, that's when Social Security Administration determines when you are of full retirement age. At 67 seems like it might be a long time. Some people want to punch out at like 55 or 60, but based on Social Security, that is what they determine as your full retirement age. Now, number two, the primary insurance benefit, that's a little bit different. They're a little bit one and the same, but the primary insurance benefit is your actual dollar amount that you're entitled to at your full retirement age. And then depending on if you take it early or later, that insurance amount's going to change. And then just as an acronym, SSA stands for Social Security Administration. Okay, so when you're calculating your benefits, you want to look at this chart. Some of you may be born from 1943 to 54, and that is your full retirement age at 66. Okay, so 66 is the full retirement age if you were born between that bracket. But again, as you take your benefits, depending on when you take them, you can look at these different percentages as far as what you're sort of entitled to at certain ages for 62. But then as the population started getting older and older and Americans started living longer, they realized that Social Security needed to change. And so they actually started extending out that full retirement age over the course of like 7 or 8 years to where eventually it got from 66 all the way to 67. So some of you, if you're born in this kind of range here, might have some really random full retirement ages, 66 in 2 months, all the way up to 66 in 10 months, to where we've got it here at present day is 67 if you're born in 1960 or later. Okay, so this is sort of the chart to dovetail if you want to figure out what your actual full retirement age is. Okay, this is not necessarily Social Security related, but it's an interesting chart to sort of look at when it comes to retirees and people planning for retirement, because a majority of people plan on retiring a lot later than they actually want to, or they feel they have to. And so if you kind of look at these numbers, about 60% of people think that they're going to retire prior to 65 years old, right? And that's a pretty good goal. I mean, if you want to, the sooner the better, right? Go play, go do all the things you want. And about 40% of people want to retire after 65. But when you actually look at the numbers of people and what they actually do, it's very different. And it's not necessarily the fault of the retiree. A lot of people in this age range right now are in what's called the sandwich generation. All right, some of you might still be working and fully in your careers, but you might have elderly parents that are sort of aging and need a little bit of help. So you've got to take a little bit of a back step to your job to kind of tend to your parents and help them out. Also, at the same time, you might have, teenage kids in high school or college that still haven't got off the couch and you're sort of supporting them. So you're kind of sandwiched in between here. And if you look at the numbers, it's closer to 80% of people actually retire much earlier than what they planned. Okay. And so half of what they actually thought, remember this was 40% in the previous slide, 20% actually retire later than what they thought they were or wanted to. So this is really interesting. So it means that a lot of times people get forced into taking their Social Security benefit earlier than maybe they had planned. Okay. This is a really good chart also to sort of look at as far as looking at the percentages that you gain or lose by taking Social Security earlier or later. And some of you might still be 66 as your full retirement age, but a majority of folks now are actually 67, right? People 66 as their full retirement age are like 69 years old now. So a majority of you that are probably watching this are between 66 and 67. But just kind of taking a look at this, the way that it works is if you take your full retirement age at, let's say 66 or 67, there's no unreduced or increase in the benefit. However, if you start to take it early, every year that you take it early, they start to reduce your benefit by a little bit. Okay, so if your full retirement age is 66, the soonest you can take it is 62. Okay, so that 4-year period, if you took it those 4 years earlier, your benefit is going to be reduced by 25%. If your full retirement age is 67, it actually gets further reduced by 30%. Okay, so and then you're locking in that benefit for life. Okay, so a 30% reduction in income, you get it for 5 years sooner, but depending on when you're going to live, again, nobody really knows that, nor do they probably want to. So there's a big decision on how to do that. Whereas if you're fortunate enough to try and delay it, every year you delay it, you get this 8% boost. They give you a delayed credit. The Social Security Administration says, hey, thanks for giving us a little bit of a reprieve. We'll pay you later. We'll give you an 8%. It's very difficult to find a guaranteed 8% from anywhere, let alone the government. So the 8% is pretty good if you can delay this. So if you delay it, you could essentially end up with 124% of your benefit if your full retirement age is 66, or 132% if it's 66, or 124% if your full retirement age is 67. So the numbers are pretty staggering on both ends. Okay. And this is Social Security used to be 65 for full retirement age. They changed it to 66, and then they had all those phase out ranges in here. 67 is most common with the full retirement ages now.
You're going to probably be talking about it soon, but regarding being able to accept somebody else's Social Security. So can a current wife draw Social Security from a former spouse once they reach 62. So what age does the
Typically, the ex-spouse needs to be 62 as well.
that's what I'm
So
saying. So the current spouse has to be 62 and the previous former spouse has to be 62.
yeah, that's my understanding. Mm-hmm.
And then also
there's other things that go in there about like how long was the marriage, has anyone remarried, et cetera. So
she was previously married for 20 years. So she does.
Yeah. So 10 years is usually the number. Mm-hmm.
And then one other question, do you have a break-even age for delaying from full retirement age to age 70? So you were talking about I know.
Yeah, it's a little specific, but again, I'm going to throw out a range, and we'll kind of dive into that here in a little bit. But typically, when you're debating on whether to delay from age 67, I'm just making up your full retirement. Let's say 67 to 70. So those 3 years. If you're looking for, okay, well, if I can take my benefit at 67, I get that benefit for 3 years more, even though I get a larger benefit on the back end of that, at a certain point, those dollars are going to converge and there's some sort of break even. It's very different for a lot of people, but typically what I see, it's between like 81 and 83 years old. That's typically.
So you need to live till 81 to 83.
Yeah, somewhere in there. So again, it comes a little bit down to a life expectancy play. So you're going to look at your family history, right? How is your health? And sort of what do you think is going to happen in that range? I mean, we'll get to a slide here in a second. Life expectancy is, pretty much in the late 70s now, and women tend to live longer. And coincidentally, married couples actually have higher statistical probabilities of living longer together than individuals do, siloed or bifurcated. So there's all kinds of things that go into that. But if you know when you're going to expire, that might be the easiest way.
That actually is the easiest way. Okay. All right.
Okay. So this is just talking a bit again about collecting early versus collecting late. This is a big one. And many people don't realize this, but if you're going to be working while collecting Social Security or even working part-time, there's certain rules around when you're going to be claiming and how much money you can make. So if you're taking Social Security or if you're taking it early, like 62, 63, 64, there's a certain dollar amount you're allowed to make working part-time before they actually start clawing back some of your benefits. So we'll get to that here in a little bit. Obviously, longevity, we talked about that. Most of the clients we work with here, we try to run you out to age 95. Many people joke about that. They don't want to live to 95, but again, we got to be on the safe side. And then your spouse, right? Are you married? Do you have an ex-spouse? Do you have an ex-spouse that's deceased? I mean, there's all kinds of ways to claim benefits. The age gap between the two spouses is a big consideration as well. How large is one of the benefits versus the other spouse's benefit? And then whose benefit can you collect, right? If you've been married for multiple times, you might be able to collect off of one spouse for a period and then switch over to another one. And so this is what I wanted to spend some time on here, because I've seen this a lot with people that they sort of want to twilight into retirement, maybe not just have a hard stop date and they want to work a little bit more. They want to consult or do something like that. And if their plan is to sort of work a little bit and take Social Security early, you've got to be really careful with how much part-time income you're going to make. So the Social Security Administration has certain rules where if you are under full retirement age and you make more than $21,240, they will start taking some of your benefit back. And they will take $1 for every $2 over this. So just for example purposes, if let's say your benefit is $20,000 and you make $21,242, that's a 2. They're going to take $1 away from this, $19,999 is what you would get. Okay. That doesn't seem like a big deal, but sometimes what happens is it's a little unexpected. Like, for example, let's say you're 61 years old and you retire at the end of the year, but you worked a full year at the company you worked at and you were entitled to a bonus, but that bonus doesn't get paid out until like March or April of the next year. And you take Social Security in February when you turn 62. And then you get this nice little, let's say $40,000, $50,000 bonus. I don't know, making up a number. Well, that's a pretty significant amount. In the Social Security Administration's eyes, you worked that year. You had earned income. You paid FICA wages, and you will receive your benefit from your age 62 benefit the entire year. And then when you file your taxes, the IRS and Social Security, they're in cahoots. They talk to each other and they're going to see, oh, you made $50,000 this year and you took benefits while you were under full retirement age. We're going to take away $1 of your benefit for every $2 that you earned. But you won't actually feel that until a year later after you file your taxes. So it comes as a shock to some people if they don't know this. Okay, so this is really important to make sure that you're accounting for that. And then this is another one as well. If you actually, the year that you reach full retirement age, if you claim your benefit, the year you turn, let's say 66 or 67, and you have more than $56,000 of earnings, they're actually going to claw back more than that. If they take $1 away for every $3 over that. Okay. So they give you a little bit of leeway, but not as much, or sorry, this is more leeway. This is pretty penalizing if you're not careful. Okay. But once you reach full retirement age, you can make as much money as you want. If you want to, consult, make $1 million, there's no limit, no penalty, no reduction, nothing. You're all good there.
Quick question for you.
Yeah.
Someone just was asking, will you ever get that money back or is it gone forever?
Yeah, you do. You don't get it in a nice, pretty lump sum. You actually get it back sort of on a monthly basis once you get to your full retirement age.
But you don't you don't get that money back that you lost. You just start getting your income.
You get the money that they took away back to you at full retirement age.
Got it.
Mm-hmm. But you got to wait all those years for them to get it. Mm-hmm. If you look at the different stages of, married couples, female versus male, if you look at a married couple, again, all of these examples, everybody's 65 years old. Married couples statistically have a higher probability of someone living to 90 or 85 years old. So statistically, 63%, means that one spouse is going to live to that age, and 84% of a chance that someone's going to make it to 85. But when you silo them and you say, okay, well, a female has a higher likelihood of living by 11%, actually, females are going to live longer, just statistically speaking. And so when it comes to, generating a benefit or deciding on who's going to take the benefit, if one spouse has a higher benefit, even if the income is needed, it might make sense for the higher earning spouse to try and delay the benefit just for the overall household benefit if the survivor is, let's say, going to be a female, right? And then the statistics go down even more for males. It's a 33% chance to make it to 90 and 54% to make it to 85. So this is also one of those strange themes where as you get older, you also are expected to live a little bit. Okay. All right, well, let's do some case studies here. And again, these, I'm going to full disclosure, these are not perfect. These are, kind of easy, kind of cookie cutter ones. We've got David and Carol walking the beach. It looks like at low tide, it's cold out. David is married to Carol. David is the higher wage earner, and both of them have full retirement ages of 66 years old. Okay. So we're going to kind of walk through some different ways that they can take their benefits. We'll even expire them at certain points and show you the differences in some of the incomes and their lifetime benefits. I think the results will be a little bit surprising. So let's just look at the numbers. So David, his benefit, his full retirement benefit is $2,200. Okay, I think if my math is right, it's just over $26,000 a year. Okay. And so Carol is entitled to half of David's benefit. That's just the way the Social Security Administration runs it. Half of David's benefit is $1,100, right? We're assuming Carol has no benefit, okay? I don't know, she's just got no benefit. So 50% of 2,200 is 1,100. This is the maximum benefit that Carol can get from a spousal benefit. Okay, we'll talk about survivor benefit in a little bit. And so let's just take a look at kind of a standard case where they both take it at their full retirement age. So they collect their benefit, $2,200 here, $1,100 here, all is good, no changes. Everyone kind of gets the maximum that they're entitled to. We're not killing them off here. That's just kind of how it works at its basic level, right? Spouse gets half, okay? And so the way that the spousal benefit actually works, it's actually more penalizing than your actual own benefit, right? So if I'm the primary, let's say in a Social Security benefit, and my spouse takes it early, it's actually more penalizing for the spouse. And so again, 100% is the maximum or the 50% spousal is the maximum that she's entitled to, or the spouse is entitled to. Every year that the spouse takes it early, it gets reduced. And the maximum reduction ends up being 30%. Okay. For someone who's 66 years old, if they took their benefit the earliest possible, it's a 25% reduction. Okay. And so just to keep that in mind, you can see the different percentages and how that actually impacts you as you go down the age spectrum here. But again, no matter what you do, the maximum you can get is always going to be half of the full retirement age of the largest Social Security benefit. Okay. And so you can kind of see as a teeter-totter how this works. And this is a very big misconception with Social Security and the spousal benefit. Everybody assumes that the spousal benefit is just half of the primary spouse. It's actually a combination of the spouse's benefit and the primary earner's benefit. So for example, or again, $2,200 is David's. The maximum that Carol is entitled to is $1,100 because that is half. In this example, we've got Carol who's got now she has a benefit of $600. And let's say Carol's benefit, she takes it at full retirement age. She gets her own benefit. She gets her $600. And then she only gets $500 off of her spouse, even though she's entitled to $1,100. It's because she takes her own. Okay, but the maximum, the ceiling is that $1,100. So she's only getting a $500 spousal benefit. Okay, in this example. But then again, just showing you how it's a little bit more penalizing on the spousal. If she takes her own benefit, but now she takes it at 62, again, there's that 25% reduction. So she gets $450, but because she's also now, her husband's taking it early, the husband gets a reduction because he took it early and she took hers early. So now it's a double whammy. She gets a 30% reduction. So now she's only getting $800. So she's eliminated the ceiling of her benefit. So if you take spousal benefit, your husband or the spouse that has the largest benefit has to be taking the benefit for the spouse to collect. Okay. You can always take your own benefit early, but you are not entitled to the spousal benefit until your other spouse is taking theirs. And that's assuming that the benefit is larger. Okay. So just for example purposes, if Carol's benefit wasn't $600, let's say it was $1,300. Well, $1,300 is larger than half of David's. So it wouldn't make sense for Carol to take a spousal benefit. She would lose money. Okay. Even if Carol took hers early, let's say she took it at 62 and her benefit ended up being like $900. Because she took her benefit early, it also reduces the entitlement of the spousal benefit. Okay, so just know that taking it early is going to affect both things. And then on the flip side, this is another one too that we'll kind of talk about here. When you actually look at delaying to 70, in this example, it actually doesn't benefit Carol to delay to 70. She actually leaves money on the table here. Because again, Carol's benefit is $600. That's her full retirement age amount. If she delays it to 70, yes, she gets 132% of her benefit, which is almost $800. And then when her husband takes it, regardless if he delayed it to 70 and gets a much larger benefit than $2,200, she's capped, remember, at half of the full retirement age amount. It does not matter that David delayed it. So even though she's entitled to that $1,100, she only gets $300 off the spousal benefit because the max is $1,100. So essentially those years that she delayed and waited to 70, she left money on the table, about probably 30, 40 grand that she could have been receiving, didn't reduce her benefit. And then once her husband started his at 70, again, under this assumption, she could have actually then taken the spousal and gotten the $1,100. So just kind of looking at those numbers. Okay, so that's a little bit about spousal. It's a little confusing. Survivor benefits are no different. They're just as confusing and they get very into the weeds if, especially if there's like deceased spouses, ex-spouses, things like that. But these numbers are pretty interesting. If you look at people or women collecting off their husband's benefit, about 50% are taking their own benefit. Some are taking the husband's benefit only, and then combined is about 27%. But the way that survivor benefits work is essentially, it's almost like a step up. Essentially, whatever the highest amount of Social Security is what that survivor is going to get. Okay. But you don't get both benefits. So again, using David and Carol again, let's say $2,200 was David's benefit. Carol's benefit is $600 still. Let's say David took his benefit at 63 years old in 6 months. So he gets $1,833. That spousal ceiling that we talked about in the previous slide of $1,100 is completely eliminated. Spousal and survivor benefits are very different than spousal benefits. So you almost get this like stepped up amount. So Carol, if she's the survivor, would actually be entitled to the full benefit that David was getting at the age that he passed. So this is, again, where it kind of can come in if the primary Social Security earner has a bigger benefit and they can push that out as long as possible, you're locking in that higher benefit for the survivor of the two. Because inevitably what happens is typically both spouses don't pass away at the same time. Usually there's a survivor for a number of years after. So if in this case, let's say it was $2,200 at full retirement age and Carol was taking in $600, that's a $2,800 a month value that they're getting from Social Security. But if David passes away first, Carol then takes over this $2,200 survivor benefit, but her $600 goes away. So there's still a reduction in the overall Social Security benefit to the household, but the survivor always gets the larger of the two, which is still affected also by the time in which someone claims the benefit. So again, in this one, David claimed it early, so she receives the lower benefit, even though it's higher than hers. And then if David delays it to 70 and passes away at 71, Carol's entitled to the entire Social Security benefit. So she gets kind of that bigger number, even if she's capped at that $1,100 a month spousal floor. Okay. All right, so let's do some case studies here. We'll go through a few of them, and I think the results of this will shock you a little bit. So again, we're going to start with David and Carol again, collecting at age 62. Okay, so they're going to take it early. Both of them are taking this early. So again, David's benefit, 62, we're going to kill him off at 75. So 62, he's bringing in $1,650. Remember, he's taking a 25% haircut because he took it early. If he was 67, if his full retirement age was 67, it would actually be a 30% haircut. So if you're just kind of looking at the math. So his benefit is $1,650. Carol also takes her benefit early at 62. So she's only entitled to $450, but she lives longer. She lives 7 years longer to age 82. Okay. So David collects his benefits of about $277,000. Carol collects her benefit. Those over that course of months gives you a certain dollar amount. And then if you kind of go through longer term, that 7 years of a difference, it comes out, where's it at? Come on, give me the number. So there's the spousal benefit that we talked about, right? Because Carol took hers early and so did David, the overall spousal benefit is reduced. Okay. And so here's the actual dollar amount of that strategy. So you get the benefits, Carol's taking hers, this is what she claims off the spousal, and then this is what she gets for that 7 years of survivor benefit, equals a total of about $550,000. Again, that's both of them taking it early. David's passing away at 75, Carol makes it to 82. Okay. And then taking a look at another one, I'm just going to fast forward through all these. Cool. So now let's look at it through a different lens of full retirement age. Okay, so presuming they can make it and stretch the dollar a little bit further, get to full retirement age, same benefits, $2,200. David lives through 75. Carol's got a $600 benefit. She makes it 7 more years to age 82. Okay, so again, the full benefit David gets, because of the way that spousal benefits work, Carol's always going to get hers first, and then whatever the difference is to that $1,100 ceiling. Okay, so she's getting $1,100, he's getting $2,200, $3,300 is coming in. And then eventually David passes away at 75. Carol makes it, she steps up to this 2,200 once David passes. And so over this lifetime, it ends up being actually $580,000 over their lifetime. Okay. So a little bit of a bigger benefit there. So 550 if you took it at 62, 580 at full retirement age. And then let's look at this one. So again, longevity wise, if you feel like you're going to live a long time, you're absolutely going to get the most money out of Social Security by delaying it to 70, right? You get 124 or 132% of your benefit, depending on your full retirement age. But again, we don't know when we're going to pass away and how much money we may or may not leave on the table. So if we sort of look at this example of delaying to 70, this gets back to one of the previous comments I made where Carol left some money on the table by not taking it early. So if they delay it again, say 2,200, 75, he makes it to 600, and she makes it a couple more years to 82. David's delayed benefit is now $2,900, which is pretty good. But that doesn't mean Carol's spousal benefit is any larger or entitled to a larger benefit. She's still capped at that $1,100 floor, which is half of the full retirement age amount. So she's going to take her own benefit, again, 125% or 124% of her benefit. She gets about $800, and then she gets to take the half because David's taking his, which is $300. Again, still capped at the $1,100 ceiling, but there wasn't a reason for her to do that. She should have been taking her benefit since full retirement age because she would have gotten the entire $600 along that $600 a month for those few years. And then once her husband claimed at 70, then she would have gotten this $300 anyway. It actually would have been larger. It would be $500. And so she, in this case, there's something left on the table. But look at this number. This is what's kind of crazy. Assuming, again, these expiration dates here, it was actually in their least interest to take it and delay it to 70. They would have been better off taking it at full retirement age or even early at 62. Now, that's not saying that everyone needs to rush out if you're at 62 and go take Social Security, right? You run these numbers. But under these assumptions, it actually didn't pay off to delay it to 70. And so let's actually take a look at one more case here. And this is the one that I think may surprise some of you. There's a huge difference in this one. So $2,200 again, 75, same setup, $600, 82 is the expiration. David's collecting his at full retirement age. But Carol kind of changes things. She's like, I'm just going to take mine early, right? I want a couple of bucks to spend on myself. So she takes a delayed benefit of $450 a month. And then once David starts taking his benefit at full retirement age, she can then jump up and get a spousal benefit. Again, because Carol took her benefit early at 62, that $1,100 ceiling is now reduced because she took hers early. So she doesn't get the full amount. She gets $950. But collectively, over these different timeframes of making it to 75 and 82, you can actually see the difference under this strategy. It's almost $600,000. So it's a pretty big difference between delaying to 70 and taking it, her taking it early at 62, and then the spouse taking a full retirement age. Okay. So just the way that the math works. And again, these numbers may look totally different if Carol made it to 85 or if he made it to 77. Right. I didn't run those numbers, by the way, but just saying. Okay. So this is talking about the difference in benefits. Whoops. Go back here. This is again, assuming longer life expectancy, 85, 92. It kind of makes sense. Obviously, if you live a little longer, you're going to get more money out of the system. So it's a little over $1 million if you make it into, this is well past life expectancy for both spouses. Again, probably a 25% chance that actually happens. So it's not an insignificant amount of percentages, but could happen.
Just so you know, you can ask your advisor these questions as well if we can't get to them. But one question is, will the survivor get the full spousal benefit if the spouse dies before taking any Social Security benefits? Mm-hmm. So the spouse who dies was still working and not collecting.
Mm-hmm. Yeah, it just depends on when they take it. So the survivor is eligible to take it at 60, a little bit sooner than 62. And again, this goes into a spider web of different strategies, but then the surviving spouse, if they have a benefit, can actually delay theirs as long as possible and collect off the deceased spouse if they wanted to. But yeah, the Social Security does a pretty good job. I'll give them credit for that, of making sure that the highest benefit gets paid out.
When you're talking about earned income, they wanted to know, does the same apply to interest income or capital gains income, or does it have to be on a W-2?
I'll get to that in a second. I got a couple of slides that I think will be able to answer that question.
Okay. And if we don't
down
get
to
to your
taxation.
questions,
But to that person's point, it's only earned income. So if you retire at, let's say, if you start collecting at 62 and you're working, it's only earned income. Your capital gains, your interest, your real estate income, your pensions, those don't count toward that calculation. It's just earned income, FICA wages. Just putting another wrinkle into there, there's also different benefits that divorced spouses can be entitled to as well. So again, just kind of bifurcating these here. Spousal benefits are if you were married to an ex-spouse for more than 10 years and you have not remarried and you're both at least 62, or you've been divorced for at least 2 years. And there's a little bit of a caveat there. If you were divorced after being eligible to take Social Security, that's waived. But there's, again, a little bit of a spider web here, kind of a trail that you have to follow to make sure you qualify for some of these. And again, that's spousal benefit of an ex-spouse. Survivor benefit is if you are divorced and that person you divorced died, you are eligible for some of their benefit as well, assuming you satisfy some of these rules, right? You were married to that person for at least 10 years. You have not remarried, but you can get married after age 60, and you got to be 60 years old. Okay, the survivor benefit, whether you're married or not married or divorced, is always 60 for survivor benefit. Okay. This is where we're going to start talking a little bit about taxation. And I want to go through this because there's a little bit of a misconception on actually how Social Security is taxed. Yes, it is taxed depending on where you live in the country. California doesn't tax Social Security. It's just federally. But the way that they calculate how much of the Social Security is taxed is a little funky. It still goes through our normal tax brackets, the 10, 12, 22, 24, all of that. But the way they actually figure out how much of the benefit is taxed is a little interesting. So it's all based on this concept called provisional income, which is just the way you calculate that is they take your Social Security benefit and they chop it in half. And they say, okay, well, you're getting $24,000. We're going to start with 12 grand. And then they add ordinary income, which can be real estate income. It can be pension income. It can be wages. It can be anything like that. And then they also add your dividends. They add your capital gains. And if you think you're going to be clever and have non-taxable interest like municipal bonds or something, they add that back too. Okay. So they take half your Social Security benefit and then they add up all this other income that shows up on your tax return. And then they throw it through this little bracket. Okay. And so if I'm just going to use the married because it's closer to me and I don't have to go all the way across the screen here. We'll do a case study here in a second, but the first $32,000 of that combined half of Social Security plus all of that income, if it's between $0 and $32,000, none of the $24,000 benefit is taxed. Okay, I'll say that again. Again, just going back to this slide. Again, in that case that I just did, let's say $24,000 is what your benefit is. They chop it in half, so that's $12,000. Okay. And then they add all of these income sources to it. So just let's say your interest, dividends, capital gains, you've got a pension coming in. Let's say that's another $20,000 combined. So that calculation is $32,000. Then it gets run through, so 32,000. Then they run it through this. And again, I'm going to use these ones. $32,000 was what we had as provisional income. So none of the Social Security benefit, which again is $24,000, none of that is taxable federally or at the state level, depending on where you're at. Okay. So a little confusing, but let's say you have bigger chunks and you start falling into these brackets, right? Where a piece of your income is then half of the benefit that falls within this is 50%. Again, that's not the tax rate. That's how much of the benefit is subject to tax. And then if you go over $44,000, up to 85% of your Social Security can be subject to tax. Okay, so let's do a little bit of a case study. I'm not a huge fan of this is working top down. I like to work bottom up because I like going through it like the tax brackets do. But just for example purposes, here's the case. $20,000 is what we're working with as far as Social Security. And then there's $40,000 of IRA income. All right, I'm messing with this. So that total, again, half of Social Security is 10 grand. plus 40,000 is $50,000 is the provisional income. Okay. So let's run it through this little calculator here and see what we get. Okay. So 50,000 is the total provisional income. 32,000 of that, though, is not subject to any tax. So that leaves us with $18,000 left. Okay. So 18,000, then you got to go to this bracket, but it's $12,000 large, right? So 32 to 44, that's a $12,000 window. So of this 18 grand, 12,000 of it's going to fall in this bracket, which is 50%. So we know that $6,000 is that number. And then we also have another 6 grand. Again, 18 minus 12 is 6. $6,000 is subject to this top bracket, which is 85%. That's $5,100. Okay, so $5,100. That total is $11,100 of the Social Security that is subject to tax. Okay, that's how the math works. It's a little funky. I don't know why they do it that way, but that's just how it works. So of that total 20 grand of Social Security, 55% of it is subject to tax. Okay, so 11 grand. That's how it works. Now, if you flip it a little bit different, let's say you have a larger Social Security benefit and a smaller IRA withdrawal. Okay, so $40,000 is the Social Security benefit, $20,000 IRA. We take half the Social Security, which is 20 grand, and then we add 20,000 from the IRA withdrawal. So $40,000 is the provisional income. If we walk through that same math, $40,000, 8 grand of this is left over at this 50% bracket. Okay, you do the math on that. 50%, and that brings us to that number. So $4,000 of that 40 grand is taxed. So it's only 10%. It's a pretty small amount. So you can kind of see it's a little interesting. Even though it's a larger Social Security amount, less of it is taxed because of the provisional income and the way it's calculated. Okay. So taxation of Social Security, no shortage. So that kind of brings us to kind of the nuts and bolts of this, but it's like, what does the future actually hold for Social Security? And the question is, no one really knows. I think everybody has kind of this understanding that the actual Social Security fund, it's, OASI, is actually due to be depleted by 2033. So that's not too far away. It's 10 years. That goes pretty quick. So 10 years from now, the Social Security pool of money is actually expected to run out. So there's going to have to be some sort of changes or overhaul of that system. And then by 2035, the actual number of Americans 65 and older that are going to be receiving is 58 million versus today it's over 76. So actually I got that backwards. So 76 million in the future. So a lot more people are going to be collecting from it. So there needs to be a lot more people paying into it. Unfortunately, the way that the projections look is that's not necessarily the case. Right now, there's 2.3 covered workers for each beneficiary, and currently 2.8 workers for each Social Security beneficiary. So there are less people paying in and more people taking it is kind of what this is saying. I have not seen the math on this. I'd be curious to know, but it would be interesting to see how the millennial generation and the Gen X or the Gen Z generation factor into this as they kind of come up and start getting into the workforce a little bit more. But I don't think that math has been done. And then by 2097, this is a ways out, but the disability trust runs out. But this is the big one, right? I think everyone's kind of concerned about that. And I don't have an answer for it. It seems like it would be a pretty simple solution just to raise the income floor. Instead of paying in at 160, you just increase that. Nobody really wants to play with Social Security because, again, 90% of Americans are relying on that for some sort of pretty big fixed income source. It's sort of political suicide for each side to fight that battle. So I don't know how much it's going to get done in the near term. As with many deadlines, it doesn't usually get done until the 11th or 12th hour. So I would expect that's probably the case. Outside of that, I don't know, Catherine, if we have a couple more minutes for questions.
We have several questions, but they are very detailed. So what I would recommend is that they talk to their advisor directly because, for instance, one is if I retired earlier this year, I should have earned an income of $150,000. If I wait to take my Social Security until next calendar year and I do not work next year, will I avoid any reduction in benefits? And the question being, is it based on each calendar year? So
Yeah, there shouldn't be an issue there. If you worked, if you had income this year, you don't take any benefits this year, and then you collect it next year, that's not going to hurt you.
And then does a divorced spouse also need to wait until the ex-spouse begins taking Social Security? It might be
I believe that you just got to wait till that ex-spouse is 62.
So if one is, if you are divorced and you had a spouse that you were married to for longer than 10 years,
Okay.
and you are ready to collect Social Security, they can take the spousal benefit as soon as they're 62. I
believe that's accurate. I think with Social Security, that someone did the math. There's like thousands and thousands of ways to claim it. And again, at the end of the day, there's no right or wrong answer because we don't know when we're going to sort of leave Earth in a sense.
Sure. All right. Thank you so much. Have a wonderful day.
Thanks, Catherine. All right. Bye.